Let's dig into the elephant in the room, the fire insurance and the Cal Fair plan. Obviously, with the recent wildfires in LA, the one in Paradise, the ones near us, how has that impacted home insurance in California?
Yeah, so a couple things. So there's two sides to it. Well, there's multiple sides to it. So I'll start with, stop me if I get into stuff that we need to spend a little more time on. But so first, the biggest thing is reinsurance. A lot of consumers don't understand what reinsurance is, and reinsurance has a huge role in cost of insurance, eligibility for insurance, the ability for carriers to come in and offer insurance. So reinsurance is insurance for insurance companies. They're global companies. It's a pool of money that's being paid into these reinsurance carriers, and these reinsurance carriers respond to catastrophic events like hurricanes, wildfires. But remember, because they're global, they're selling it to multiple countries, multiple carriers. So just because we have hurricanes in Texas, or the hurricanes in Texas aren't the only hurricanes impacting reinsurance costs. Hurricanes in other parts of the world, in other countries, wildfires in other parts of the world are impacting reinsurance. There's not a whole lot of reinsurance companies, but reinsurance is basically paying for a majority of these losses. So let's go to the Palisades fire. So the Palisades fire, let's talk about Fair Plan, because Fair Plan does have reinsurance. Farmers has reinsurance. Allstate has reinsurance. Every
Can,
company buys.
can I stop you there
Yeah.
real quick? I want to make sure everybody understands what Fair Plan is too.
Okay. Yes. So the California Fair Plan is an association that was established in 68. And basically everybody that is an admitted carrier in California, so there's admitted and non-admitted. Admitted are part of the association. They're regulated by Department of Insurance. They're the big names. They're the Farmers, Allstate, State Farm, AAA, Geico, Progressive. There's a lot of admitted carriers in California. But in order to be considered admitted, you have to be part of the association. The association is the California Fair Plan. And so what happens in the event that they can't provide insurance, home insurance to a client, Fair Plan is meant to be last resort. So you go to Fair Plan and say, hey, I can't get fire insurance from any other carrier. I need to get a Fair Plan policy because I need to get fire insurance. So, and many states don't have Fair Plan. So we're actually very blessed to have Fair Plan, because it would be very difficult to continue to maintain home insurance in California without it. So you go to Fair Plan, you buy a Fair Plan policy, covers fire and wind. It doesn't cover water, doesn't cover liability, doesn't cover theft of personal property. That would be a separate policy that you purchase. We call it a difference in conditions or wraparound. The Fair Plan, basically, the Fair Plan is really carrying a lot of exposure in California now, because we've seen a lot of carriers non-renew policies from the pressure of reinsurance. And we've seen a lot of companies leave the state because the exposure for wildfire. So in the Palisades fire, Fair Plan had about 5 to 6 billion in losses in property loss, so homes that burned down, and they had about 800 million in the bank. So obviously there's a disparage there, right? How are they going to pay claims in the tune of $5 to $6 billion when they only have 800 million in the bank? So a couple things that Fair Plan can do. So Fair Plan did go to their reinsurance company, and their reinsurance company, I believe, paid close to 5 billion of the losses. So, and if you look at most major wildfire events in California, I would say it's very similar in most carrier situations, where the reinsurance company came in and paid, say, 75% of the loss. So the insurance companies are getting limited to 500 million or a billion or 2 billion. That becomes their deductible, let's call it. And then reinsurance steps in and picks up the rest. So Fair Plan had money from their reinsurance company that came in and paid a majority of it. They also had money in the bank. And then now, as an association, what they do is they go and they assess all of the admitted carriers for the remaining amount. So I believe they assessed the carriers for about $1 billion. And so that assessment came back over to Fair Plan, and that's how they continue to pay claims. They also got a line of credit, I believe, from the California Infrastructure Program or Fund, just for backup, but they ended up putting money back in the bank. They paid claims. And so if you think about the situation Fair Plan's in, they're very strong as far as being able to pay claims, because every insurance company out there that's admitted in California is backing the Fair Plan or backing the association, a member of the association, which is the FAIR plan, which is going to be your fire coverage. So these fires, the way they're going to impact premium is they're not just going to impact the FAIR plan or the companies that got hit by the fires. They're going to impact every part of the industry, every carrier, because carriers had to pay these assessments, which are going to obviously get trickled down to the consumer. Some companies had reinsurance that would pay the assessment, and some companies' reinsurance contract didn't do that. So you'll see some assessments turn into, collecting some of that from the consumer. Some reinsurance is going to pay it. But at the end of the day, FAIR plan survived the Palisades. It'll survive the summer fires, but that's what FAIR plan is. So that's a lot of information, but that's how reinsurance and insurance carriers operate together.